Michael, thank you very much for joining us today. How are things in Denver?
Well, actually, I'm north of Denver, about an hour and a half. Things are great. Good weather, nice view. Anyway, winter's coming. That'll be nice.
That's good. That's good. Um, first of all, I got to let you know this is my new background, my new setup here. You're the
Hmm.
first one that I've interviewed with my new background. I got my money tree here. What do you think of my money tree? I'm hoping it's going to bring me good vibes.
Well, ship me one of them, will you? I like one of those too.
I might have to get two of them.
Okay.
Anyhow, the last time we spoke was in April. I can't believe that. And so much has changed since then. At that time, the S&P was at 5,500. Now we're at 6,600. I can't believe it, but it's up
Hmm.
12% on the year. The NASDAQ 100 was at 19,600 at that time.
Hmm.
Now
Hmm.
it's at 24,500. It's up 14% on the year. We've had
Yeah.
a massive rally off the April lows. And at that time, you said your message was don't trust this bounce. And
Hmm.
yet we've gone significantly higher here, and it looks like this market will not stop. It's just like a runaway
Yeah, it's
train. So
it's
what is your view on the S&P and the Nasdaq 100?
we do not trust them. Price action has made new highs. By the way, it's not all that big. Yeah, the move to get here was big because we came from the depths of hell. S&P dropped down to 4,800 from being over 6,000. And now we're, I think, less than 10% higher than we were in February high in the S&P. I think that high was 6,100, if I'm not mistaken. So we're, far less than 10% above it. And it's been creepy crawly. The explosion from that April low, if you look at just a price chart, which we look beyond that, but was rapid. And then when you got up near the high, it's creepy crawly the whole way. It doesn't look, it almost looks abnormal. I'm not going to say it's a conspiracy, somebody's buying it like the government to keep it up, but it's just not behaving like a normal inhale, exhale market. It's like incremental. And every day they make a new high, it's by a quarter of a point, a percent, etc. But we don't trust it. Momentum is broken, meaning back in January, the S&P had made a high above 6,100. It started back down. And no, yeah, in early January, and in fact, it made its high in February, I think. So it made a high a little bit later. But above 6,000, we got negative because momentum, long-term momentum, meaning things like quarterly momentum. It's when you measure each monthly bar in its relationship to a three-quarter moving average. So you oscillate it. You create an oscillator, which is what we do. You don't just look at the average. The average itself could be meaningless, whether you're above it or below it. You build structure on the momentum chart, just like you do on a price chart. Uptrend lines, flat floors, that kind of thing. Almost always, momentum will shift out of a given trend into a new emergent trend before price will. Okay. If you go back and look at the 2000 top, or you go back and look at the 2007 process of topping, which was spanned basically a year in each case. There was a point after which you broke enough things to say, oh, momentum says you're topping, you're no good. But price goes up and nips out a new high. Let me give you an example of a false breakout. The peak price in 2000 was 1550 on the S&P. The peak price multiple years later, 2007, 7 years later, you finally got back up to 1550 again. This was like in the spring of 2007. So you'd 7 full years just to get back to where you were then. And they sold it there again. And you dropped from 1550 S&P into the summer, pretty nice little sell-off. And the double top guys said, "Oh boy, we nailed the double top," right? Okay. Price came back up and broke out over the early 2007 price high and the 2000 price high. So it was like what you call a triple top breakout on price. You got up to 1576 in October of 2007. Why? The Fed cut rates in September. First time they cut rates in a long time. Everybody was partying. Let's buy the market. They had a price chart breakout. The orthodox chart analysis would say, oh boy, this is really good. That was the top, period. Went 25 points beyond the old highs, and everybody was cheering, and it just sort of quietly slumped back below them. Big mistake. and a bear market ensued. Momentum already argued before that event occurred, don't trust price. Same thing is happening right now. Do not trust the new price highs. A lot of sectors within the market have not made new highs, by the way. Even if you look at the Mag 7, flip through those 7 charts, how many have made new highs? I think it's only 3 or 4. Okay. Yeah, they've all bounced with the market, but some of them didn't make a new high like the S&P. So even the leadership is gotten sharply narrowed. So your leadership is narrowing. The breadth of the market is narrowing. It's only, recently it's been Meta. What else we got recently that's helped the market go up? Oracle recently. But there's a lot of stocks at the front end of the S&P that are heavily weighted. They account for like 50 other stocks at the tail end in terms of weighting. And they've made new highs, but it's extremely narrow and very distorted. So we don't trust it. I think money has already begun to move out of it and move into other asset areas, particularly gold and silver. But anyway, that's our assessment of the stock market. I think we're making a major bull market peak, and we've been doing it since early this year.
So just to summarize, even though the S&P and the NASDAQ are making new highs, your view is the momentum of both indices is declining.
Yeah, the momentum is having a rally, but it's already broken its structure. In other words, if you looked at a momentum chart of the S&P, like quarterly momentum or any other long-term metric like 100-week average and stuff like that, you've broken an uptrend that goes all the way back to that 2022 low. Okay, so the uptrend that was defined by multiple lows, nicely drawn trend line on momentum, you blew the heck out of it in April. In fact, you broke it in early March. And in some cases, you broke it in January. But then this whole rally, when you look at a momentum chart, isn't making a new high. Where is it? Where is it right now? Where has it been stalling? Because, this creepy crawly action we've been getting is up underneath that which you broke on momentum. So if you looked at a momentum chart and treated it as a price chart, you'd say, hey, this is a rally up under a place, you ought to sell it. Okay. So we trust momentum more than price, and we're doubtful of the stock market. Plus, if you're in markets to make money on a relative basis versus other asset categories, gold has been beating the pants off the S&P for, actually it's doing better than the S&P for the last 10 years. Okay, in terms of where was gold in 2015 versus the S&P, we're much higher. You go back 3 years, we're much higher. You go back just the beginning of the year, you're much more up on the year than the S&P is. I think gold's up like 40% on the year, and S&P's up what, 7? From where it closed last year, or whatever. It's so the issue is, where should I be? Not whether it's going up. And another point to make: there's always a degradation of money by the central banks. The Fed is equal accomplice to the ECB or the BOJ. They all print when they need it. And when you break these stock markets, they'll go gusher again. But if you go back just arbitrarily 25 years, quarter of a century, an investment lifetime, let's call it, go back to October or September of that year, September of this year, so it's been 25 years. S&P is up 3.5-fold. Gold is up over 11-fold. Yeah, big swings, so forth and so on. When if you got into gold wrong, you got hurt and so forth. But basically, from a long-term point of view, gold is up 11-fold, more than 11, and the S&P is up 3.5-fold. So anyway.
So one of the things that really confounds me about this market is the amount of money that keeps going into it. And you alluded to this earlier, but the S&P is currently trading at 22 times, forward earnings. And that's a very rich number. And that's in spite of all this negative news associated with trade wars and tariffs, et cetera. And then if you look at the Buffett indicator, which is just the total value of all stocks in the US divided by the GDP, it's also trading at or near all-time highs. It's well over 200% now. And so it doesn't matter what matrix you look at, this market is highly overvalued, And so if and when it breaks, Are you okay? You're already saying the momentum is starting to break, but when it does break, where do you see the S&P going? If it's at
Uh,
6,600 right now, what are we looking
no,
at? 30, 40,
no,
fifty
no
percent
prediction on
pullback?
that. No prediction except to say you go back to the 1920s and look at the 23 to 29 bull, the dimension of it upside in terms of percent gain in the Dow, the number of years, mid 70s high, ended with the crash in 74. Gold was exploding while it crashed, by the way, in December 74. Or look at the 1994 to 2000 high, about 6 years, doubled or so for S&P, triple for NASDAQ. This bull market since 2009 is a bubble beyond all bubbles. Now, it is starting to fit into those metrics that you're looking at, which are foggy metrics, meaning they're not precise points to sell. They just say be distrustful. Okay. And they're probably correct. But remember, the movie Big Short, okay? Where there's three or four guys in different parts of the country who were sort of unorthodox, said, hey, we got a mortgage crisis coming. And they were right. And they were laughed at by their peers, you know. And even after, but they said this in late 2005, 2006, 2007. It wasn't until you got into 2008 before the reality that they knew was coming came. So sometimes you can have these metrics, like you mentioned, that are sort of fundamental metrics that are valid, but when? When do I act on them? And that's what we focus on. And so what we're saying is we're topping. The next leg down is likely to be the start of the one that actually gets the attention of the public. In other words, it won't be a quickie like April was, which was panic and unfortunately headline associated. Tariff nonsense. Okay. As if that's not the reason this market's going to go down. This market is a bubble beyond all bubbles in terms of increase over a period of time, and it's been created by such factors as monetary, particularly. Look at an M2 chart, upward curvature, okay? In fact, that's been ongoing for decades, but it's really, you know, upward curve on the chart over the last 20 years or so. And then look at the Fed funds rate chart. I mean, for 10 of the last 15 years, rates were at zero. I mean, that's Cheech and Chong time. Get high, boy. Enjoy it. Buy stocks. Get all the money you want. It's free. Okay. And even when they raise rates up to 5%, if you go back 75 years and look at that rate compared to 75 years, it's at the low end. So we've been drugged with monetary policy, and that creates bad decisions. Because one of your foundations of your thought process when you decide to build a new factory or sell your home and buy a bigger one or, et cetera, is the cost of money. And if all of a sudden the cost of money is like, hey, it's free, or next to, or cheaper than reality, then you make a decision based in part, large part, on that issue. That could be a mistake because if that's not sustainable, and also, once you get these bubbles created, every time they make a top, 2000, 2007, Fed started cutting rates. It never helped. The market collapsed anyway. So it went somewhere else. And I'm already seeing where it's going. Gold, silver, and now recently, especially the gold and silver miners.
So you mentioned the movie Big Short, fabulous movie. I've probably seen it a half a dozen times.
Yeah.
Another movie you have to check out is called Dumb Money. Have you seen that one?
No,
That
no.
one is all based on, it just came out, I believe, 3 years ago. It was based on GameStop and that whole time period.
Oh, okay, cool.
You got to
Okay.
watch it. It is a classic.
Yeah.
But you mentioned bubbles, and you're saying this is the bubble of all bubbles, and I would totally agree. I guess one of the things that really astounds me about what we're seeing right now is that it's just not one bubble, it's a bubble after bubble after bubble, right? In the last 5 years, we had initial coin offerings or ICOs, then we had NFTs, we had thousands of cryptocurrencies. I mean, you and I could start a cryptocurrency right now.
Yeah, let's create
We've
our own
had
money. Why
sports
not? Let's
betting,
do
we've
it right
had,
now. Yeah.
yeah, sports betting, zero dated options trading. Like the
Yeah.
level of speculation going on now is
Mhm.
something we've
No.
never seen before
Yeah.
in the history of mankind. But, and of course, AI, I almost forgot about that. But when you see these extremes in speculation, does
Mhm.
that concern you?
Well, it's again, it's one of those wet noodle indicators that it's a reality, and ultimately it probably plays. But again, the question's when, because this has been going on for a while now. Okay, I understand from various bank reports that I've read or heard about of analyzing their customers that are invested in the market and have an account in the bank that does that. The use of leverage has never been higher than it is now, and yet it's persisting. Okay. So you can make an error, but keep making it. And the longer you make it, the worse the consequence, probably. But again, the issue is when. Okay. Yeah, it's a reality. Those are objective facts. But again, when? And that's what we're focused on. And I do think it's a key factor right now because when it does crack, we know what's going to happen to the central bank. They're going to go berserk, even more so than they already are. Um, which case they'll lower rates, but they'll also increase money supply, et cetera, et cetera. But and that will impact other markets as well, because when they push the throttle, especially gold and the monetary metals will accelerate even further. Not that they're dependent on it, because they've already anticipated that event. Money's already started to flow. Not particularly American money, by the way, but other parts of the world have gone into the monetary metals. Wait till that starts. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it, and they sold it, thought, oh, this is the top, this is the top. It wasn't at the top, it was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid 30s, lower 33, 34 area for a year. In fact, it had been, in fact, in last May of 2024, it was up to 32.70. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sep, oh, boom, silver goes from mid 30s to what? 43. Okay. So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, uh, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm going to move some money over there. Well, when they do, it's wet bar of soap time. Squirt on the upside because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it, just an assumption.
Yes, I would agree with that assessment 100% because Newmont, as a reminder to our viewers, back in January, February, it was down on the year. Now it's up 115% on the year.
Yeah, yeah.
Second best performer in the S&P, only lagging behind Palantir. So now that we're talking, let's do a deeper dive on gold. And I want to show a couple of charts that you have sent me. The first one is called the Gold Monthly Ratio Scale, and it goes all the way back since 1975. So it gives us a great overview of
Mhm.
what's happening and where you think the price is going.
Yeah, right now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and it'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. You went from 2000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market, and go back 50 years when the government approved it for us to trade, God bless them. You've had two bull markets. There were eightfold moves from bear low to bull high, different duration of time. One was from 76 low to 1980. The other was from 2001 low to 2011. But they were both eightfold multiple gains for gold. We bottomed at 1,045 in December 2015. If we get eightfold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even fourfold yet. Okay. So that's something to consider. I don't trade off of it. Maybe we're not going to go eightfold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced.
Okay. Sorry, Michael, I didn't hear that. So gold's currently at 3,600, 3,700 bucks an ounce.
3,700, yeah.
Or
That's a triple, from its low,
a triple from its low. So what would that be?
Well, the bear low in 2015 was $1,045, so 1,050, let's say. So you've tripled it. Fine, that's great, a little more. But you're nowhere even half what those were. Those were eightfold moves. And a lot of that move occurred in the last year or so of the move. In fact, that was the case in both cases. Most of the move occurred late in the bull trend. So, and again, duration was different. One was a 3.5-year bull, one was a 10-year bull. So, maybe this one's already a 10-year. Well, but I think the dynamics are such that what you're going to see over the next handful of months, especially over the next year, in terms of monetary metal upside, is going to be awesome and far different from the tone we've seen over the last 10 years in gold, for example.
So if somebody hasn't gotten involved in gold yet, what's your message to them?
Well, they're late, but on the other hand, it's a reality. Do I get in or not? I suggest yes. Our preference, well, especially when you look at gold miners. Gold miners, we don't have any charts on this, but relative to gold, the valuation of, for example, the XAU index, which has been around since the 1980s. The 1980s, 90s, and into 2000, like up until about 2007 or 8, it was trading at either side of about 25% of the price of gold. In other words, divide XAU price into gold, it was about 25% of the price of an ounce of gold. It would oscillate above and below there. In fact, the low end of that multi-decade range was about 17.5%. So let's remember that. In fact, when you see the spread chart, if you have one, we publish it routinely. Let's call that resistance now. In other words, if you ever get back up there, you bump your head on it. Okay, where is gold right now? It's like pushing up toward, it's at 7.6, 7.7%, I think, right now, XAU divided into an ounce of gold. So you could double and a half the miners right now on a relative price basis just to get to the underside of the prior multi-decade valuation that they used to have. So they are a vastly underpriced category of the monetary metals. And I think somebody's woken up and said, hey, this is cheap, low risk, I'm in. And that's why you've seen them get goosed. But even getting goosed to where they are, for example, GDX or XAU, just recently, the last few weeks, have taken out the 2011 price high. Gold did that, when it took out 1920. So they're just catching up.
Yeah. So even though a name like Newmont's up over 100% on the year, Kinross is up 140%, Agnico's up 100%,
Yeah.
you still think there's a lot more room to go?
Oh, no, I think they've just begun because all they've done is they suddenly come back to where gold was at about $2,000, back in 2020. Gold's now 3,700. Well, they're just getting up to the 2000 level. And in fact, taking out the $1,920 high we had in 2011 on gold, GDX just took out that high. XAU just took out that high. So in effect, it's saying I'm back, okay, and it's still cheap. Because I mean, if you take 2011 to the present, 14, 15 years or so, uh, and you say, what's the real value of the currency unit we're using? Real spending value, it's decreased markedly because the money supply like doubles almost every decade. Well, heck, just to match the 2011 high, uh, you could probably double the current price of the miners and they'd still be where they were in real value terms versus 2011. And that puts us on the issue of silver, of course.
Yeah, and to your point, many of them haven't taken out their 2011 highs. So Agnico, I believe, might be the only name.
Well, many of them have. Most of the silver miners are still way behind, but they're accelerating, like SIL, the ETF of the silver miners. Is it a point of breakout versus GDX? Meaning, which do I buy, the gold miners, GDX, or SIL, the silver miners? I would suggest silver miners because there's more slingshot effect there likely, meaning further percent gain than GDX will produce over the coming year or so.
So let's talk about silver now. The other chart I want to show our viewers is another chart you sent me. It's the silver versus gold. And why don't we take a look at this and then give me some indication of where, first of all, how undervalued silver is in relation to gold and where you think silver might be going.
Well, if you look at that chart, what it shows is pick the monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from like, 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16%. Okay. We're very suppressed, very depressed relative to that norm. Okay. And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%. And back in the 1980, got up to 6% plus. Okay. So just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at. But when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay. So it's catching up. But there's a breakout level on that spread that says, I'm going to launch. And we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level. Probably even further, but let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold went dead sideways at 4,000, let's say, and silver went to 2%, you do the math. Okay, $80. If silver goes to its norm, gold goes to its normal 8-fold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high. GDX, XAU. Gold's way above its 2011 high. And even a bloody base metal, copper, is currently trading above its 2011 price high. Is silver going to stay a dog forever, or is it a mistake? And you and I know, being in markets long enough, you'll find markets that get excessively overdone on the upside and are making a mistake, and other markets that get excessively cheap and cheap relative to other assets on the downside and are ignored and ignored until finally they wake up and you say, golly gee, I wish I'd realized that. Whoosh. And silver, our argument is the technicals argue to us silver between now and the end of the year, in all likelihood, is going to gush past 50 and be in somewhere in the 60, 70 range. And that's not the top. I'm just saying as the first gush. Ultimately, we're going up to that 2% level. The question is, where's gold going to be? And by the way, whenever that spread breaks out, it never is the case that silver gains versus gold because gold goes down more than silver. It always gains because silver goes up net price more than gold goes up. And whenever that spread breaks out, favoring silver, it's usually an indication of verticality in both metals.
And so once again, your message is if somebody has not been invested in silver yet or in silver miners, there's
Get
still
in
lots of time.
soon.
There's
Get
still the
in.
big move. We've still yet to see it.
We've yet to see it. We've seen an arm wrestling move. You're not too late. Now, there will be a point where the volatility and the price swings will be even more dramatic, but we're not at that point. We're at the
Right.
point now where the gusher, I think, is going to occur. The gusher that takes silver into a new reality and suddenly smacks investors in the face and they say, golly, silver just took out its two old highs, which are relics, really, in terms of how far back in time and the real dollar value of silver in 1980, if it was 50, this many decades later, its real dollar value would probably be 200, okay, just to match that high. Anyway, that's where I think we are, and I think it's not too late, but things
And,
can change quickly in terms of that.
and let's just say gold tops out here in the next few months at 4,000 bucks an ounce. 2% of that would be $80 an ounce. So,
So, yeah, in any case, yeah. But I
and
don't
that's
think
at the low end.
yeah,
It could be
yeah,
3%, which would
yeah,
be
yeah.
120.
But even if you just go to the norm of 21 of the last 50 years, and in the bull market years, it went way beyond that. But even if you just go to 2% again and sort of say go back up to the surface level, okay, it's a huge percent gain for silver relative to gold. And I think it's underway, and we've started to see it since the beginning of this year. Silver's up a lot more than gold, especially since April.
So, Michael, we can't have a discussion on gold without talking about the US dollar, and it's been under pressure this past year. It's down 10% as measured by the DXY. What are your thoughts on the USD?
Dollar index made a high at 115 back in 2022. It was still low compared to decades ago. Okay. It dropped sharply into 2023 down to 100 area and went into a dead range 2023, 2024, and early 2025, 100 to about 108. They had one spike up to 110, but basically most of the action was in about a 7 to 8% range for 2 years, which is very dull, almost non-eventful. A lot of other markets were making big moves. It wasn't. It was not a factor. When it turned down from early highs this year and got down to 104 again, actually 104.21 was the close of March, we turned major bearish. Price-wise, you're only in the middle of the prior 2 years range, but momentum said you're gone. So momentum broke. Price didn't yet. Annual momentum of the dollar broke trends that went back 10 years, sometimes more, went to the 10-year average momentum of the dollar, which is even a longer term yardstick to measure momentum. Even longer back, you broke a beautiful uptrend line that you could see on momentum, you cannot see it on price. On a price chart, what's been going on since that drop from March to April, once we made a low in April, by the way, which was coincident with the stock market low, dollar dropped sharply with the stock market. The dollar tried to bounce with the stock market, and it went into an up-down range from the low of April, below that level and above that level, 4 or 5 point swings. And every rally, everybody said, oh, the dollar's looking good. There was an uptrend line on a price chart of the dollar that goes back a decade that any idiot with a crayon could draw, and they did. And they've been buying it since the April low along that uptrend. Momentum says it's not going to hold. We're back now this week. We've traded back under 97 this month, back down to the lows of the move again. I don't think you're going to hold this time. And when the price guys finally realize, oh, my trend line's not holding, let's say you close a month out at 96.50 or 96, just a little below where you are now. They're going to realize, oh, we made a mistake. That line didn't hold. Well, momentum already says it's not going to hold. We think you could go down into the 70s again, if not make a new low, below the low of a decade and a half ago, which would create turbulence in other asset categories. Like you've said, we've dropped, we've been bearish since 104, so you've dropped a pretty good number of points, but it's really not that earth-shaking. The next 20 points could be earth-shaking in terms of wave effects. And that's when it'll start to impact other markets that up to now haven't been impacted severely by the dollar's movement. And again, this isn't real dollar value. This is dollar value versus other pieces of paper. Yen, the euro primarily, and the yen, they constitute 70% of the dollar index.
Now, I want to ask you about the US financials. And the last time we spoke, you were quite concerned about them, but a lot of these names have put in serious moves. We got JP Morgan trading at or near all-time highs. It's up 30% on the year. Goldman Sachs, it's up 40%. Morgan Stanley up 25%. What are your views on US financials?
In the April break, when the S&P actually in January started breaking the longer-term momentum, especially as showed in April, March, April, and many indexes. If you go and examine the quarterly momentum of half a dozen of the major banks, which we put out a report on it recently, but also within the financial sector, look at credit card companies like Visa and MasterCard. They've gone vertical recently too. And yet we hear all these, you turn on your radio when you're driving down the road and you hear these ads on Sirius radio, whether you listen to CNN or Fox Business, it doesn't matter. We'll help you with your credit card debt. So many of these ads, why are they doing that? Are so many people in trouble with their credit cards? Well, we know they are. We know that people are using their cards up to here. Many people are getting more past due. Defaults are increasing, et cetera. And yet these stocks behave like we don't care. They're drugged up. They don't care. When we run the momentum of those type of stocks within the financial sector, we find that the April break broke through some stuff intra-month, but came back and closed with enough of a bounce. So basically all these bank stocks, the biggest ones you could name, and Visa and MasterCard rebounded enough to say, ooh, I'm back in a safe zone. Unlike what the breakage occurred in the S&P, for example. They didn't break the structure, but it's down there. And I'll tell you where you're trading right now. When we move into the next quarter and we adjust up the 3-quarter moving average, and therefore it shifts the zero line on our oscillators where your relationship to where that average is, you're going to drop these momentum readings back down to death's door again. You cannot afford even a minor sell-off in any of these symbols once we get into next quarter and close a month like, 2-3% below where you are right now, for example. Visa can't close where it is right now. It's going to break its quarterly momentum once we get into the 4th quarter. So we're keenly watching a sector that most of the public really isn't watching because all they see is the beauty of the price chart. Momentum says something totally different. It says you're standing on death's door. You don't look good. Momentum is not making new highs. In fact, it's got a structure that if you saw the momentum chart, you'd say, oh boy, I got to sell that beast when he goes through that floor. And if you got,
I'm not sure if you're following this sector. It's buy now, pay later. Have you been reading about this?
Yeah. No. Oh yeah, the new industry that's arisen. Yeah, I've heard about that. Yeah.
And so a company just went public here recently called Klarna.
That's very indicative of something, isn't it? I think it is. Yeah.
Oh yeah, and their numbers are exploding. Anyhow, it's just amazing because you have this younger generation, especially that they're buying something today and they're going to pay for it tomorrow, but it just keeps snowballing, right?
Let's see if they
and the other interesting thing about this Klarna is that a high percent of the revenues are people aren't paying.
Mm-hmm.
think it might
Hmm.
be 18 to 20% of their revs.
Yeah,
Okay.
yeah.
Like,
If that gets worse, then what do you do? What are they going
yeah,
to do?
yeah.
Somebody's behind them, where they borrowed money too, so okay, some lender out there. That's why you got to these type of events could impact the banks. I also think Bitcoin is a disaster waiting to happen. And that could be the ambush that really shocks people because we have structure on the Bitcoin. When you look at a price chart, you see these nice three waves up since we got bullish in late 22, early 23. It was down the 20,000 level. But since then, it's created this bull trend that just looks lovely. Hey, happy times. But when you run a momentum chart of it, quarterly momentum, for example, you have a replica of the 1987 S&P quarterly momentum chart in terms of, uh-oh, I got something below me that if I break, I'm gonna collapse. Right now, Bitcoin's trading 116,000. I think the recent low is down on 107,000. You better not revisit that low next quarter. Or when you look at the price chart, you say, well, it's not that important. Momentum says, no, you blow the hell out of a floor that you've built since 2023. Multiple lows hitting the same level on momentum, not price. And I think that could be a psychological and financial ambush because Bitcoin now is financially important. 10 years ago, it didn't matter. It was a game on the side. Now, so many companies have got deeply involved where it's actually financially consequential. So, if we're right on the potential for Bitcoin to not just go down, but to go down sharply, that could be the kind of event that upturns a lot of people's thought processes. It's not coming from where they expect it. And that's the way bear markets usually begin is someplace, oh, God, I didn't think about that. Okay.
I think one of the things that's so confounding about this environment that we find ourselves in is that the S&P and the Nasdaq, they're making new highs every other day, but the economy just keeps chugging along. I mean, if you go back 8 months,
Yeah.
10, 12 months ago,
Mhm.
everybody was very
Yeah.
concerned about the trade wars and the tariffs. It was going to be inflationary. Everybody's talking about a global
Yeah.
recession. But here we are. We only got 3 months left in the year.
Yeah.
Markets are making new all-time highs. The GDP is growing at
Mhm.
2.5 to 3%. Um, the jobs numbers,
Maybe,
this is,
maybe,
yeah,
maybe it
jobs
is.
numbers. Now,
Where's
this
your
is the,
data source?
yeah, yeah.
Yeah.
Uh,
Okay. Yeah.
Jobs now, that's a little bit concerning. Like we saw this massive revision here. Every month we get massive revisions, but we just had one for the full year ending in
Yeah.
March
Yeah.
of 2025. We lost, or they
Yeah.
revised down 911,000 jobs.
Yeah. But
Like,
why even listen to it? Because if they have to adjust it that much, then it means the whole thing's, what does it mean? You know, if you can't trust, if they changed it, 50,000, I'd say, okay, that's pretty tight. But that much says, what do you pay attention to this stuff for? You know, uh, and besides, usually in bear markets, when you look at those data points, the real dark numbers that come after the stock market's really started down. Then you start to see the numbers. Oh, golly gee, I wish I'd seen, so usually those numbers are lagged to reality anyway.
I guess one of the things I really questioned though is inflation, because once again, like 2% inflation, forget it. We're never
Hmm.
going to see that again. It's firmly at 3%. Let's say if you
Hmm.
believe the government numbers, I always double whatever the government says, I double it. So let's say it's running at 6%, right?
Hmm.
I was just in London, Michael, and a cup of coffee, like in Toronto for an Americano, I pay $3. In
Hmm.
London, it was $6. I don't know how the
Cool.
hell these
Cool.
people survive over there.
Must
I
be
got a
good coffee.
cab from the airport to downtown London. It was £100, which is 200 Canadian dollars.
Yeah, yeah.
Okay, just think about that.
That's cool.
Uh, like I don't care where you go in the
Yeah.
US, in Canada, over in England, inflation is out of control. And the only thing saving our butts right now is oil. Oil's hanging in the low
Yeah, don't
60.
count on that saving you for too long because we run monthly studies on Bloomberg Commodity Index and all the key components, the major components within it, the grains, meats, energy, base metal, copper, so forth, sugar, cocoa, all that. Bloomberg Commodity Index looks primed for a major next up wave. Right now it's trading about 103. You don't want to ever close a month out during this year above 106.52. If you do, I'm going to break annual momentum out of a basing pattern that it's been in for 2 years. Remember, Bloomberg hit a high, Bloomberg Commodity Index. It went from a low under in the high 50s back in 2020. It was going down while gold went up, by the way. It was different from gold. And exploded from that 2020 low up to the 2022 March high. It peaked a few weeks after the war commenced at 140. So it more than doubled. Okay. And we call that move. It's since pulled back to 100, actually gotten in the mid 90s repeatedly. But the last 2 years, you could draw a line across 100 and it goes up, and just nowhere. Totally quiet basing. Crude oil's had a similar type pattern, roughly call it $65 or so, 65 to 70 zone, sideways for a couple years. Next quarter, you close out a month, it's 68 or higher. Don't expect it to stay down. It's going to explode. And I don't know the reason why. It's not going to be a war event in all likelihood. It's just I'm underpriced. I've been here for too long and I'm going up. And the Bloomberg is in the same position as crude oil. And therefore you could get an ambush out of the commodity category of inflation. Inflation really is the degradation in the money unit. Sometimes it shows itself in stock prices. Sometimes it shows itself in commodity prices. Commodities are vastly underpriced. I mean, you're 103 on Bloomberg. You know where you were in 2008? 237. Okay. So commodity prices are hardly, quote, high. Gold's above those highs, but Bloomberg is, less than half the price high I saw in 2008. So if it turns up again, that's going to shock people because we know we have an administration that was elected on the notion of, I'm going to keep commodity prices down, and especially a gasoline price. We see crude oil as very technically ripe for an explosion. And that's another ambush in investment categories that few people are anticipating. Certainly not President Trump.
So you are north of Denver, and I'm always curious what people are paying for a gallon of gas. What are you paying?
I think it's like 350, something like that for the premium.
350?
355, something like
So
that.
I'm based in
I'm
Toronto, and
expecting
if you
that
do
to
the
go up to,
conversion on the
4.
FX
Pardon me?
into
Yeah.
gallons, I'm paying 375.
Okay,
Guess what they were paying in London?
I'm 850.
It's around $7.
Not
$7 a
kidding.
gallon if
That's
you do the
cool.
conversion.
Well, that's cool.
Think about that.
Yeah.
Like,
Choke, choke,
I,
choke.
I, I
Yeah.
really don't know how people can survive in that town. Like,
Yeah.
well, okay. So let's just summarize a few of our points here. S&P and the NASDAQ, they continue to make new highs price-wise, but you're saying don't trust it. The momentum has broken. Gold, silver, you're very bullish. They're going significantly higher. If you're not long, there's still ample opportunity to get long because the price is going significantly higher on both. You're very negative on the US dollar. And then commodities overall, you're bullish. And it sounds like you're bullish on
Well,
oil.
I'm pending bullish. We've got our trigger numbers, and we're very big on that. And we may anticipate a trend by seeing structure built right for breakout one way or the other. Okay. And usually when momentum builds a structure that smacks you in the face and you could see a major upside breakout pending or a downside, it usually happens. Momentum doesn't build structures not to use them. And right now, commodities are saying the opposite of what stocks are. They're saying, hey, we want to go up. We're undervalued. Stocks are the opposite. And I think money moves. It doesn't leave everything historically. When the stock market goes down, everything doesn't go down with it. Gold goes up. Sometimes commodities go up. Late 70s example. 2008, 2011, commodities were up, stocks were down. Anyway,
And
that's
when it
where,
happens fast. Like remember a year
yeah.
ago,
Mhm.
we were griping because nobody was paying attention to gold
Yeah.
and silver. And here we are a year later, and look at the moves.
Yeah. Yeah.
Astounding. All right. Well, this has been a great discussion, Michael, and I want to thank you very much for spending time with us today. And if somebody would like to follow you online or check out your research or your services, where can they go?
OliverMSA.com. Take some time, look at our methodology. We discuss it at length, probably boring amount of length, but we explain it. It's unorthodox. We've got a lot of old sample reports there on site. You can see what we said at various times and why we said it. And if you want a sample report, request it.
And I will also include some links below in the show notes. Once again, Michael, thank you.
Thank you much. See you again.